when price moves in the opposite direction of the RSI. That is, so now we got the RSI value as 66. So this is how we will find out the RSI. Hi friends, welcome back to my YouTube channel Trader Chitra. Today we are going to learn what is RSI and how to use RSI in our trading. We have two types of indicator in technical analysis. One is the leading indicator and other is the lagging indicator. And RSI is the leading indicator. This is the part 1 video where I am giving introduction to the RSI, and in my upcoming videos you can see how RSI has been calculated with the examples and different types of strategies using RSI. Now we can jump into the topic. RSI. RSI is the popular momentum oscillator introduced in 1978 by J. Willis Wilder. And as I already told you, it is a momentum indicator which helps to identify the trend reversal. Why do we use RSI? Because sometimes price may not always give the exact information. In that case, we need some added tools which helps in identifying the trends and price action better. We can see the definition of RSI. As the name suggests, RSI tells us the relative strength of the particular asset, and the value of the RSI ranges from 0 to 100. And how can we predict with RSI that price reversal is going to happen? How will a trader know that the price is going to reversal at the particular price? That is, if the normal perception is when the RSI is above 70, it means that the asset is overbought. And if the RSI is below 30, that means the asset is oversold. And RSI calculation is based on the 14 periods. That is the default settings given in the RSI indicator. The default value 14 also can be changed according to our trading setup. This is the picture of RSI oversold and overbought. The top is the price and RSI is below here. This is the RSI indicator I have mentioned below, and the upper band level I have marked as 70 and lower level band I have marked as 30. And if RSI has came below 30, it means that the asset is oversold, and from there chances are there for the price to reverse. And the second picture is overbought, means if the RSI is above 70, see this blue line, this purple line, this is the RSI line, that purple line has gone above 70, means the price is overbought. So chances are there for the price to reverse from there. This is the formula for finding out the RSI. RSI equal to 100 minus 100 divided by 1 plus RS. Now we have to find out what is RS. RS is the relative strength. The formula for finding RS is average gain over n period of time divided by average loss over n period of time. So we got the formula for finding out the RS. So we can rewrite this formula as RSI equal to 100 minus 100 divided by 1 plus average gain by average loss. We have to find out average gain and average loss. So average gain equal to sum of gains divided by 14, as RSI is based on 14. So we have to use 14 here, and average loss equal to sum of loss divided by 14. So in the indicator, if we are changing the 14 length as 5, means we can use 5 here. I will show you how can we calculate RSI. Here I have plotted the 10 days example of the particular stock. So this is the days I have mentioned here, and this is the closing price of the stock. The next two column is how to find the gain and the loss. So first day the closing price of the stock is 198 and second day it is 200. So what is the gain here? It is 2. And the third day is 205 and the second day is 200. So the gain or loss, we have a gain here. So it is 205 minus 200, it is 5. And day 4, the closing price is 210 and day 3 is 205. So we have a gain as 5 rupees again. And day 5, the closing price of the stock is 207. Compared to day 4, it is 3 rupees less. So we have a loss. So here it is 3. And here it is 215 and 207. So here we have a gain of 8 rupees. And here it is 210 and 215. So here we have a loss of 5 rupees. And day 7 is 210 and day 8 is 220. So here we got a 10 rupees gain. And day 9 it is 210. So here day 8 is closed at 220. So here we have a loss of 10. Day 10 again it is gain of 5. Now we have to find the total number of gain. Total number of gain is how much we have to find it out. So I am finding the total sum of. So we got the 35 gain and loss 18. This is the sum of gain and sum of loss. Now the formula for getting the average gain is sum of gains divided by 14. So equal to 35 divided by 14. That is 2.5. And average loss is sum of loss divided by 14. So equal to 18 divided by 14. So loss equal to 1.3. Now we got the average gain and the average loss. So now we can find what is the value for RS. RS equal to average gain by average loss. So equal to average gain equal to 2.5 divided by 1.3. So this is the value of RS. Now the formula for finding out the RSI is 100 minus 100 divided by 1 plus RS. Now we find out the RS, that is 94. So that is equal to 100 minus 100 divided by 1 plus 1.94 is 2.94. So next is we have to find out 100 divided by 2.94 is what. So we can find out 100 divided by 2.94 equal to 34.01. Now we have to find out what is 100 divided by 2.94 equal to 100 divided by 2.94 equal to 34. So we got the value here as 100 minus 34. So what is 100 minus 34? 66. So now we got the RSI value as 66. So this is how we will find out the RSI. Now I will give a quick recap how we find out this value. The RSI formula is 100 minus 100 divided by 1 plus average gain by average loss. So the next step for us to find is average gain and average loss. So we came to the Excel here and we got the total number of gain and total number of loss. So we found out what is average gain. Average gain is equal to total number of gain by 14. That is how we got 2.5, and total number of loss divided by 14. We got average loss as 1.3. Now next is to find out RS. How we'll find out RS? RS equal to average gain by average loss. We got it 1.94. So finally we got the value for RS, which is nothing but 1.94. So we are applying here as 100 minus 100 divided by 1 plus 1.94 is 2.94. So again we have to divide 100 by 2.94, which we got is 34. Now 100 minus 34, we got the RS value of 66. When price moves in the opposite direction of the RSI, that is price is going, in this example we can see here price is going up and RSI is going down. This means it is a divergence. That is the meaning of the divergence. In other words, we can say that chart might display a change in momentum. That is, if the price is going higher high, you can see RSI is going lower low. So we will come to a conclusion that there might be a reversal in the price. So that is called divergence. Under divergence, we have three types: regular, hidden and exaggerated. We will see how each types of divergence is formed, and after that I will show you with examples. So if we understand how each divergence are formed, it will be easy for us to enter into the particular trade. We can see the types under regular, hidden and exaggerated divergence. Under regular divergence, we have two types, which is regular bullish and regular bearish divergence. So, regular bullish divergence is when the price is making lower low, RSI will make higher lows, and bearish is price is making higher high and RSI will make lower lows, lower highs. Hidden divergence, hidden bullish divergence means price is making higher low and RSI is making lower low. Hidden bearish is price making lower high and RSI making higher highs. Exaggerated bullish and bearish divergence. Extended bullish divergence is price making equal high, means the price will be on the same line and RSI making higher lows. Extended bearish, same, price making equal low, price will be on the same line and RSI making higher highs. Next, I will show you each divergence in the examples. We can see regular bullish divergence means price is making lower lows, RSI is making higher lows. You can see in the example, price here I have connected both the lows. So, price is the low here and went up and again formed another lows. So, these are the swing lows. So, price is forming lower lows. So, what RSI is doing? RSI is forming higher lows. You can see here, I have marked the RSI here. The purple line is the RSI. So, RSI is going up. That is, RSI is forming higher lows. So, what it means is price is showing weakness. So, what RSI indicator is showing us? RSI indicator is showing the strength. So, exactly from here we got a green candle. So, after that price reversed and went up. So, there is a trend reversal. So, this is the example for the regular bullish divergence. This is regular bearish. Regular bearish divergence means price is making higher high and RSI making lower highs. You can see this is one swing and this is another swing. So, this price is making higher highs. So, price is going up. So, at the same time, you can see what the RSI indicator is doing. RSI indicator is making lower highs. See, price is going higher high. So, RSI also should go higher high. But RSI indicator is going lower highs. So, price is showing strength and indicator is showing weakness. So, means we can see a trend reversal at this particular zone. So, this is the example for the regular bearish divergence. We can see what is hidden bullish divergence. Means price is making higher lows and RSI is making lower lows. You can see in the example here. Here we got two swing. So, here the price is forming higher lows. Price is going up. It is making higher lows and at the same time when you see the RSI, RSI is making lower lows. So, here we can see a trend reversal. Means price is showing strength and indicator is showing weakness. So, from here we can see a price reversal. That is a trend reversal. This is the example for the hidden bullish divergence. Now, we can see hidden bearish divergence. Means price making lower high and RSI is making higher high. You can see that price is making lower highs and at the same time what RSI is doing? RSI is making higher high. Here you can see that RSI is making higher high. So, price is showing weakness but the indicator is showing strength. So, this is called as hidden bearish divergence. Now, we can see extended bullish divergence. Why I have written weak? Because this types of divergence we may not get very often. So, I have written as weak. Now, when you see the example here, I have written like price is flat and RSI is forming higher lows. In this extended divergence, either price or RSI, either one of the criteria might be flat and the other one can be higher high or higher lows. So, here when you see that the price is flat and RSI is making higher lows. So, we can see the trend reversal after that because RSI formed a higher low. From there, the trend reversal happened and price moved up. Now, this is the extended bearish divergence. This is also weak because we may not get very often. Like in this example, you can see that price is forming higher low at the same time RSI is flat. So either price or RSI will be flat. In that case, we will get a extended bullish or bearish divergence. So after getting the bearish divergence, like price is falling down and RSI has formed like flat. And from there, we got the reversal and the price started falling here. Because price is showing weakness and indicator is showing strength. So from there again price started falling down. So this is the example for the extended bearish divergence. Till now we have seen RSI calculation and types of divergence. In my next video we will be seeing why RSI is called momentum indicator and different strategies we follow to trade using RSI.